So happy to introduce Vince Nijar from CI Investments. Vince, I've gotten him to present to the branch staff in the past, and really well received. And I thought you all would enjoy listening to his presentation. He's going to be talking about market volatility, ups and downs in the market, what to do. This call is timely. Yesterday was a really bad day in the market. Today things are flat, and so I think you'll benefit from this. We will be taking. You can email me questions, and then I can answer them, or we can open up the phone lines at the end. All right, take it away, Vince.
Oh, thank you. Thank you, Travis, for the opportunity to participate. And happy to be here. Like you said, it's timely. Market volatility, what to do, the importance of staying invested. I put together a number of slides here from my staff at CI, and I'm hopeful that it could help paint a picture for you a little bit around patterns, because so much of this, in a sense, is repetitive. The economy goes into a decline, and then the economy has some sort of recovery period. It grows from there, and then it has some sort of decline, then a recovery and growth. And same thing with the markets, of course. The markets have a good time followed by not so good, and that's the pattern. And if we can get a sense of what the pattern is like and how we react to it emotionally, perhaps we could be better as investors. So although there are a number of slides here, I'm just going to go through a couple of my favorites to help build the argument. So the first one I'm looking for is slide number 5. At the bottom left-hand corner in blue, there's a blue box, and then a number appears there. And the title of this one is "Don't Let Emotions Take Over. Staying Invested Leads to Better Performance." And when you're looking at the top and it says S&P 500, that's referring to the U.S. market. So in this case, we have the U.S. market invested in Canadian dollars. And during this investor's period of time, the investment has declined 41%. So this is an accurate measure of what happened to U.S. stocks in the S&P 500 during this time period. By the time the low appeared in 2009.
Want to highlight most of your portfolios, if not all of them, are nowhere near this risky. But this is just the overall market, what it did, and so any client's portfolios wouldn't go down as much. But it's a good thing to reference. So
yes, thank you. I'll show a few examples. So I have shown in here ideas around the S&P. So if you did go entirely invested pure stocks. Or I also showed it in Canadian dollars, as well as I'm going to show some Canadian markets. And as you're pointing out, Travis, this is not a representation, though, of necessarily of someone's portfolio. But I will show even a global, let's say, global balanced fund, just to even give a sense of what balanced funds and mutual funds may have appeared like, and how this pattern of investing in emotions. Okay, so imagining for a moment, though, that we were that kind of investor that decided to buy the entire S&P 500. Okay, so we owned the 500 largest U.S. companies that are listed on the U.S. market, and we had a decline of 41%. And what to do? And there really are, two options that I think most people would consider. One would be to get out at this point. I'm down 41. Let me forget about my losses and move on.
Stop the bleeding is one of the things I always say. I got to stop the bleeding. So yes, stop the bleeding. Yeah.
And in this case, if he did that, he said, look, I'm going to give it 1 or 2 years where I'm going to stop the bleeding. Then the $100,000 investment would have grown to either 237 or 209. But it turns out, had you done nothing and simply left the market alone, that the total appreciation would have been better, as the 100,000 would have gone to 303,000 during that time period. Looking at the next slide, which is slide 6, here what I've done is, instead of the S&P 500, I've intentionally looked at an average mutual fund that's in the category of global balanced.
So this would be for a lot of clients. This is about average risk. So if you're an average risk investor, this is what an average risk portfolio might look like.
So instead of it declining by 41%, which was the previous example, in this case, the balanced fund has has less volatility, and so it reduced to 23%. But the same thing here applies, that it turns out, even if you were the unlucky investor that came in the day before the markets had gone down, so you came in the day before, it turns out the truth is if you had remained and just rode the whole thing out, at this point, the total appreciation from the bottom would have been 151%. The blue line that's demonstrated there, that's the investor who, when the portfolio declined 23%, has said, now I intentionally want to be more conservative. I no longer want a global balanced portfolio, but rather I want to be 100% fixed income. And so being more conservative, it turned out that during this period of time, the assets would have grown by 61%, so far less than just leaving it alone. There are also those investors who said that I wish to hold cash at this point. That
wait for things to get better.
Yes, and I'm going to completely exit, and I'm going to wait for things to get better. And in this case, they are still waiting for their capital to return. So when you're waiting for capital to return, how much of a rate of return do you need? What is required? And remember that I said that there's...
This is slide 7 now?
Oh, thank you.
Yeah.
On slide 7, yes. I was talking about this idea that the markets are cyclical, right? That you get this period of time where the market rises, and then it has a decline, a fall, and then it recovers and grows again before declining. So when the market has declined, what kind of rate of return is necessary to get back to where you were before?
I really like this slide. I think this is a great slide that highlights some things that you just don't normally think about. So yeah.
The easiest one to look at is the one where it's showing a decline of minus 50%. So the red bar, and that's the third one from the right. Okay, so that one is showing a 50% decline. So you imagine $100. The $100 declines to $50, right? That's a 50% decline. From the $50 where you're down by half, what is the rate of return required to get back to where you were? From 50 to go to 100 means that 50 has to double, which is 100% rate of return. So that's why investors can look at declines and begin to sense an opportunity, knowing the pattern, knowing that if there is a 50% decline on the market, at some point during the recovery phase is going to be a 100% rate of return for the market simply to return back to its original place. So if we look at the next slide, which is slide 8, and now we're looking at US dollars S&P 500. So the American market from the Americans' perspective. In this case, the market fell by 55%. So that was the total loss of the markets back in the 2008. 2008, remember, that's the period where the U.S. housing crisis, when the housing and subprime mortgages.
It's probably the worst market loss that most investors in their lifetime had faced. And it was scary at the time for a lot of folks. And with any recession, and we see this now, I hear clients all the time say, oh, I don't like what the president's tweeting, or I don't like what I'm getting a bad sense of things. And typically, the markets will lead us into a recession, and then the news keeps on getting worse. And I remember in July of 2009, just bad news, unemployment, people are losing their jobs, factories shutting down, but the markets kept on going up. So markets usually lead us into a recession, and they lead us out of a recession. And the news, you're not going to get a good sense of what's going on in the markets from the news.
Right. It was actually, it was also called the Great Recession.
Great Recession, yeah. Nothing great about it.
Nothing great. That's right. So this decline at that time, so this is the past, it declined by 55%. We knew as professional investors that the math suggested during the recovery period, we'd be up by 122%. So that's the opportunity. This truth, although I'm referring to something in the past, it is how it would mathematically work out in the future. So at some point, whatever the catalyst is that causes the next market decline, the next opportunity is also there, and the opportunity at 49%, for example, in Canada, which is the middle of this, suggests a 94% return. That's even before the market begins its growth cycle. But I want to show you how long do we typically wait for this? So a decline has happened. When does it happen? How long? And how quickly can we get our money back? And how do we grow from there? So on slide 9, first point I want to make, though, is around bull market and bear market.
Market going
and
up,
the transition.
bull.
Yeah.
Market going down, bear.
That's right. So a rising market, the jargon is bull market. That's what Travis was saying. And the decline, of course, is the bear. And everybody worries about the bear. And on your side papers or notes, you could jot down, I'm going to tell you how long the average bear market lasts and how to think about it. But a bear market is defined as a market that has declined by 20% or more. So when the market declines more than 20, that's a bear. Okay, so the thing is, the bear market is followed by a bull market, which is followed by a bear, which is followed by a bull, followed by upside, followed by downside, followed by upside again. The upsides of the bull market happen quickly. They tend to happen within the first 3 years, shortly after the bear market. Many of the gains and the good times that are happening during the bull market, they're indistinguishable from the bear. So you couldn't tell based on the news. But the decline started happening in September 2008. That's when various U.S. banks started going under. And March 2009 was the low, and that's when the new bull market began. But you would not have anticipated that in 2009, 10, 11, and 12. In fact, investors wanted to stay away from the market because how raw the memory was of 2008, but it turned out those were spectacular years for growth.
I remember talking to clients during that time period and getting any of them to invest. They're doing the RSP contributions. And it's like, that stock market, that's a house of cards. I don't want to put my money in. And I just saw that go down. And so oftentimes, too, I have clients sit on cash and say, we won't wait for the market to drop. But when the market's falling, it's tough to invest. You don't want to invest in a market that's going down and they end up sitting on cash. And so the best is to just hold a portfolio and ride it out through up and down markets. So
agreed. There's a big difference between holding a single stock and a portfolio. Everything we have demonstrated today or been talking about is a portfolio versus a single stock. Certainly, a single stock has that kind of risk where it could go into a decline and not necessarily come back the way that we're talking about today. That's where diversification matters. And so everything we've been speaking about has been about portfolios.
Good question. We're on slide number 12 right now.
Yes, so you have multiple slides like this, like 12, which are going to help continue to build the case around, look, when you think that a portfolio has declined and you are feeling sentiments or emotions around it, a fear, it's a good idea historically to do nothing. Nothing. A couple of things here.
Burn your statements.
Burn your statements.
Burn your statements.
Warren Buffett has this line. He's a famous investor, about
one of the richest men in the world, actually.
Yes,
made all his money through investing in the stock market.
And a charitable man.
Yep. What is his famous quote?
Be fearful when others are greedy, and greedy when others are fearful. Okay, so you have a number of slides there to take a look at, but let me show you about these bad years. The first one I'm doing is on page 14, slide 14. So these are bad years, but not a bear market, because a bear market is defined as 20% or more of a decline. The language that Wall Street uses for a 10 to 20, they call it correction.
Correction. Nothing correct about that.
Yes. Okay, so a couple of examples here.
We're on slide 14 right now.
Yes. At the World War II, you have the market decline of 12%, but had you held on for 5 years, even though that was a 12% decline, what happened? You're up 117. And in all of these examples, we're showing that despite the fact that there were negative years, okay, that if you just held on long enough over the 5-year period, that negative years tend to be followed by good years, and that it takes on average 1.5 years for the market to recover and then grow from there. But on the next slide,
slide 15,
yes, it's the bear. It's the bear market one. So now we are deliberately looking at bad years with a 20% or more decline. And so when you look at examples such as recent two, there's the tech crash, so that's the NASDAQ bubble, 2002 to 2006. It began with a 22.1% decline for the investor, but after waiting 5 years, they were at 35%. And the last one on the right was the most recent one, known as also called the Great Depression, the Great Recession. And the Great Recession at the far right had an initial decline of 37, but after 5 years, total return was 9. The only exception is the one on the far left, which is the 1937 to 41 period, which is the Great Depression.
And that period for many folks on this call really shaped their lives. Their parents went through that. Their upbringing was one where the parents talked about that, and that was very raw in their parents' minds, and maybe shaped how they were raised and how things were done around the house. So that still has an effect today on many clients' investors' emotions.
Yes, understandably. It actually took till 44 to come back. In 1944, the Dow actually appreciated by 44% that year, but that one took longer. But looking on slide 16, if we may, so now we're looking at it from the same arguments we're making, but looking at it from the perspective of a Canadian balanced portfolio, say 40% Canadian stocks and 60% Canadian, 40% Canadian bonds and 60% Canadian stocks. What would have happened here? And after events such as Black Monday, so that's in October 87, where the market had declined by more than 25% in one day. And in this example, on this fund, you're down 3.3, but had you held on for 5 years, up 45.3%.
Maybe just be a good time here just to take I think all the clients on the call are just worried, like what they hear in the news right now, Vince, and maybe just we'll pause on the slides for a second. So what are some of we're hearing in the news today? Like what are some of those risks in the market, and are they a little bit overblown? Are they do you think I think that's what clients worry about? They see the president tweeting something, they see Russia, they see all these things. Are those things that are really going to affect the market, or is it more things like interest rates and like what do you see kind of affecting the market?
I do believe that sentiment has an impact on the market. So I believe that when ordinary investors get to see this kind of disruption, be it trade or be it these sorts of tweets, it has an emotional response as to how do we feel about our investments and our portfolios. Do we feel safe in what we're doing? But then the other side of it is fundamentals do matter, and how the economy is doing and what's actually taking place. And market valuations are not expensive today, even though the market has, aside from the last few months of volatility, was really at all-time highs.
Yeah, it was a good year this year.
Really, yeah, absolutely.
And if you check the news, you wouldn't know that, but it's been a really good year in most clients' portfolio, or everyone's portfolios. So,
aside from your clients who are participating, most investors aren't. The investors who are participating today are institutional and professional investors. The ordinary retail investor has the volumes of activity isn't there, and that's the kind of the strange thing about these bull market, bear markets. When does a bull market begin? When does a bear market begin? And it's hard to time these things. If you timed it based on sentiment, often you're wrong. So the fact that, and I'll show you how long this bull market's been going on. There's a slide on this, but
what slide is it?
I forget which one, but we'll come up to that soon. But the duration of the bull market, like what I'm saying is, bull markets don't die of old age. Okay, so just because the bull market has been happening for so long, doesn't mean its conclusion is necessitated. But a bull market, a bull market will end usually in enthusiasm by the ordinary investor. So when the ordinary investor is quite happy to be invested and is feeling really good about the economy and the rates of return, and is feeling good about what's happening in the presidential office, or is feeling good about, when there's a feeling that things are going good, that's when, as professional investors, get off the investments and feel like this is it.
I don't feel like anyone feels like things are going well.
Right. So when we kind of sometimes end up using that ordinary investor sentiment as a gauge to what do I think is going to happen, and I actually think that although it's more volatile today, that the bull market continues. it continues despite what we're seeing now.
And when it does end, so we've got about 10 minutes left on the call, and then we'll open up for questions. But it's always something unexpected. So in '87, that was something unexpected. The dot-com crash and the September 11th terrorist attack, that was unexpected. The 2008 Lehman Brothers, that was unexpected. So it probably is not going to be something that we see in the news right now if there is a drop in the market.
Mm-hmm. So. Looking at slide 25, I'm imagining here that although my parents didn't come from money, I put it in I was imagining that $100,000 got invested in the day that I was born, and what would happen there? And this is the Canadian market, and $100,000 would have turned into 5.7 million. Yeah, 5.7. But that 5.7 million would not have happened without significant market declines along the way. Okay, and that's also true of the American market. So on the next slide is slide 26. So that 100,000 would have turned into 9 million. But the thing is, again, you get these periods of decline that growth is simply not achieved without volatility. So in '87, the market would have declined 30%. In 2000, it shows a decline of 45%. In 2009, it's 51%. But what I am saying here, because of the pattern, is that at some point, though this graph shows that 100,000 has appreciated to 9 million, at some point is the next bear market, is a decline of 20% or more. So I'm emotionally prepared for that by understanding that that's how it works. I'm going to get at some point another bear market, but at some point I'm going to get a recovery again.
And we don't know when the bear market comes or when the recovery comes.
That's right.
So all we can do is prepare for that.
Yes.
Yeah.
I know that we can prepare for it emotionally, and that we're going to be rewarded with patience. And so
I heard one saying it's not the head that determines investment success, but the stomach. So can you stomach, riding out when things go bad? So
there are I saw the research report, actually side tangent. This company that they analyzed which investor accounts are doing very well, and it turned out they found a large quantity of accounts that the investors have demonstrated success in investing, and they wanted to figure out what is the psychological behaviors. So what's going on in these accounts? And then they realized that these accounts were dormant accounts that the investors had passed away.
You got to die to have great investment success. Don't look at it. Yeah.
But patience is rewarded. So slide 32. The title of this one is Patience is Rewarded. And what's happening here is that we're looking at rolling returns. Okay, so what rolling returns is doing is taking any period of time, a 3-year period. So in a 3-year period anywhere in time since 1960, and trying to understand what would have been the average annual compound return. Okay, in most cases, the average for investing on the Toronto Stock Exchange has been 9.6%. But the worst case scenario on a 3-year basis is 6.3% average annual return. Looking at the next slide is slide 33. On slide 33, you can see how it smooths out. Okay, because now that you're investing on a rolling 5-year period, it turned out there was only one period of time, only a single period of time, where there was a decline.
So this is a good point. I always encourage clients, don't check your investments every day. You're going to see a lot more ups and downs, and if you only check them every month, there's even less, and every year there's less, and 3 years and 5 years. And so Warren Buffett once again says, I have no problem if this stock exchange closed for 6 months. I think a lot of investors would be very well off if they didn't get statements for a year or 2 years. And so, but everyone wants information, and so this is just saying, if you kind of close your eyes and don't aren't following it really close, a lot of the ups and downs that you normally see in the stock market are actually taken out. But when you look at it every day, quite risky, quite volatile. So
right, and on slide 32 and 33, we've been looking at 3 and 5 years and saying that's it even includes the 2008 period, and still, the markets were able to go through a cycle and exhibit positive behavior over time. And even if one has a longer perspective, begins to look at things such as slide 34, there hasn't been a negative period if you look at things on a 10-year basis.
Most clients do when they retire. They think, oh, I should just move my money all into, I've heard this before, move it into something guaranteed. I said, well, you can do that, but a lot of clients are retiring at 60, 65, some 55. Chances are you're going to have 30 years of retirement there. Inflation's going to be really working against you. And so in my lifetime, inflation's probably going to go, the cost of goods is going to triple or even be up 4 times. Most retirees, the cost of goods are going to double before they pass away. So inflation, and I see that now with clients in their 80s, they retired with $30,000 a year was a really good income. Now $30,000 a year, it's tough. Property taxes go up, gas is up, insurance, everything is up, and so that's why we invest, is to battle inflation. The cost of goods going up. It's kind of like high blood pressure. If you have it, it's not a good thing, but it's silently working. So
yes.
Yeah. A couple more slides, and then we'll open it up for questions.
Okay, some of these I'll just do rapidly. Then some of my favorites. Slide 35. I'm just trying to make the point that if you were a day trader, decide, I'll just try the markets on my own. And here, over the last 30 years, just say that you happen to have missed 15 days worth, and you can see that the total appreciation, if you had missed the 15 best days, it would have been far better had you just left it alone and stayed it through. On slide 37, I just wanted to give you a sense of what volatility is like. So how many days on the Toronto Stock Exchange did the market even fall by 2% or more? So those are the days that are considered a little bit more volatile. 2017 is interesting because it just didn't happen. We happen to be in a low volatility period. So far this year, it just got broke last week. Otherwise, the market hadn't fallen by more than 2% in a single day. So that just happened once so far in 2019. But more volatile years are years like 28 and 29, where the market fell by more than 2%, 27 days and 42 days.
And you look back, it's kind of normal to see more ups and downs than we've seen the last number of years. So I know everyone gets concerned when they see the market moving up and down, and that's a normal part of investing.
Mm-hmm. So we had one, and to Travis's point, if you look at slide 38, how many should you expect though? Just putting this whole thing up like a bell curve. You could expect a decline of more than 2% to happen on eight times a year on average. Okay, so far it's happened once this year, but you could expect 8. On slide 43, I put a couple of historical facts together to show you what had happened during those time periods. On slide 43, where I'm further suggesting that market volatility, it's normal, and that dramatic losses, they sting, but it's important to keep a long-term perspective.
Over history, everyone has a moment where they go, aha, that's the moment. So my grandparents' generation would have been Pearl Harbor. That was like, why would the Japanese come and just bomb Pearl Harbor? They're coming and they're attacking America, and that was pretty scary. My parents, they all remember they were in JFK, got shot like that. They did. My mom still says we were in school, we got let out, like it was a big deal. I remember where I was when the Twin Towers got bombed. And so these events kind of anchor in our memory and oftentimes make us a little bit fearful of the markets. And that's, that's something just to think about when you do get scared. Is it because there's a past event that's kind of resonating with you? So.
Mm-hmm. I'm looking at slide 49. On 49 is where I wanted to talk about how difficult it is for professionals to predict how long before the next recession, what recessions look like.
Yeah.
A recession, it is defined as 6 months or 2 consecutive quarters of a declining economy. So 6 months. But Statistics Canada calculates the number and releases the number 2 months later. So 8 months. So by the time we declare we are in a recession and it hits the Globe and Mail, the National Post, 8 months have elapsed. The average recession lasts for 11 months. That's the total expected duration on average is 11 months. So when 8 months have already elapsed by the time we confirm it, 3 months on average are left. before the recession is over. And oftentimes the recession is over when we discovered it,
Yeah.
and when we don't feel like it's over.
Yeah. It just keeps on getting worse and worse and worse. And I heard one portfolio manager said, I never recognized a recession until we were out of one.
Mm-hmm.
So we are at half an hour, so I will maybe just pause it there and open up the phone lines for questions. Vince is happy to take questions on the current state of the markets, the president, the election in Canada, the election that's coming in the States. Vince is a bit like a slot machine. I never know what's going to come out of his mouth. So fire away. Do we have any questions? Anyone have any? The lines are open. So does anyone have any questions for Vince?
Let me just say, first of all, that I thank everybody for taking the time to listen,
Mm-hmm.
and I appreciate it, and I wish everybody success. I enjoyed hearing about your family, and I think the same thing about my dad. My mother's passed away now, but my dad is 77, and my father-in-law is also he enjoys investing.
So I got one question for you. We've got a Canadian election coming. Do you think that's going to have any effect on the markets? The Conservatives get in. We have a minority government. The Liberals get retain power. The NDP holds the balance. Like, what do you think that'll do to the markets? Do you think that'll have much of an effect on the markets, or is it just kind of it's more of a longer term thing that the politicians can have effect on?
I don't think it's going to have much effect on the markets. I think that the markets have already priced it in.
Yeah.
It's either going to be, it's a 50-50 now between a minority government possibility for the Conservatives or a minority government possibility for the Liberals. The third potential, of course, is a majority for Liberals, but I just don't see that. But either way, I think what is most important, regardless of the politics, are the deficits.
Okay.
I ultimately think that's going to matter
To hurt the Canadian economy.
Yes.
Yeah, I can see that. And I think most folks just realize that if you spend more than you make for a period of time, that's going to catch up with you. What about the U.S. markets? So what about the U.S.? So say we got a year from now, the U.S. is going to be voting. If President Trump gets in again, is that going to be bad for the markets, or is it going to be good for the markets? What does that look like?
Okay, so around President Trump, I mean, in the short term about it is the question around impeachment.
Oh yeah, that's a good one. Impeachment.
So I think that
there's a possibility.
He's going to get impeached.
Mm-hmm.
Yeah, and that they'll be able to do it both in the House and Senate.
Yeah.
That there'll be enough Republicans coming forward that the impeachment actually happens. Could he? What could happen there ultimately around? There's at least 7 potential opening spots around the Mueller investigation that never happened because Mueller's team didn't want to proceed while you're dealing with still a seated president. So if he doesn't get in and he knows he's not going to win the re-election, what he theoretically might do is he might resign, and he could do so with 8 minutes left on the clock and suddenly put Mike Pence in. And Mike Pence has been a loyal supporter, and Mike Pence, within the 8 minutes prior to Trump realizing he's not going to win, he could put his hand on the Bible, swear it'll be now President Pence, and then President Pence could pardon President Trump.
Oh, yeah.
And then those investigations need not happen. So either the impeachment or even the opening of investigations down the road, I think that whether he gets reelected or not.
That's a good point to think about. We are at 10:35. Do we have any questions? Otherwise, we'll wrap up the call. And if you have any questions, anything you heard on here you want to discuss with me personally, you can always email me or give me a call.
Travis?
Yes.
Can you hear me?
Yes, sir.
Okay, this is Kurt. I have, I think, 2 questions.
Sure.
One was with respect to free trade and how that free trade is going to impact markets, because we're seeing more and more of that
Tariffs.
and how this is impacting tariffs and that. And then the second one is more with respect to China and how China is going to have an impact on our markets.
Okay, good question. Thank you, Kirk.
There is, this is a very good question. Thank you. It's been a 40-year process of globalization. Okay, this 40-year process of free trade. We are entering a world now where the free trade mantra has expired. Okay, that's the old regime, and it's not globalization anymore, it's deglobalization. The deglobalization is also going to be long in duration, just like it took 40 years to get to this globalization phase. Okay, so that's one. And how that impacts the world is that China wants to be the leading power here, and it wants to own the global supply chain. The world is going to change from wanting to be interconnected with other countries to trade to needing to and wanting to return manufacturing at home. And this is going to be the new cycle. It will be that which has less free trade, more deglobalization, more individual manufacturing, and arguably as a result, at some point in the future, when this all gets priced in, would be a greater inflationary environment. So although, Travis, you mentioned at the beginning that as advisors, we talk regularly to investors about being sure to keep their portfolios ahead of inflation. Inflation has been so low for so long that nobody has cared. But many of your investors,
added up like over 10
time,
years.
yes.
Yeah, but year to year it's been very low. Yeah.
I think even gold prices are exhibiting today a demonstration that the gold market expects a greater inflationary period over time. So around free trade, no, it's done. It's done for the longer term, in my opinion. Around China is looking to increase its own power.
Once again, everyone has an opinion. There would be some that would say that maybe free trade would continue, but this is what we're seeing, in that there might be less free trade going forward, which would, if people have to manufacture things in Canada or in the U.S., that might have an increased cost for things. What about other questions?
Well, sorry, can I interrupt for one more question?
Yeah, Kirk, go ahead.
Okay, so to us as investors, is it better to be in bond-related markets or to stay with the capital markets?
So I can answer this one. I think having a diversified portfolio, because some of these trends, like Vince said, could take 40 years to play out, and something might change along the way. You might have a new regime come in and change, and so just because we think that it's going to happen, it may not. So I think just covering your bases and having some in bonds, some in stocks, some in global, some in local is going to be the best way to go. And historically, that's been the way that you're going to have the least amount of risk and the best return. And maybe we can have a call afterwards, Kirk. We can go over it in some more detail.
Yeah, no worries. I just thought there's some generalized comments that might.
Yeah, absolutely.
Our
Any other questions? We're 40 minutes in, and I don't want to monopolize your guys' time. So if you have any other questions for Vince,
Travis, I didn't get a copy of the slides. Are you going to send them out?
Yes, I'll send them out to you, and then I'm going to post this on YouTube. So if other folks that couldn't make it, or you want to re-listen, you can listen to it there.
Thank you, Travis.
You're welcome.
Thanks, Travis.
You're welcome.
Thanks, Travis.
We'll wrap it up there. Thanks so much.
Thanks a lot.
Bye.
Bye now.
Bye.